Stock market weekly chart review for October 17th through October 21st. We're going to look at the S&P 500 as a proxy for the overall stock market, because whatever the overall stock market's doing, it has a tendency to move any individual stock in that direction. And even if an individual stock is going counter trend to the overall market, whatever trend that individual stock is moving won't have as much oomph. It's kind of like you can either be running into the wind or with your back to the wind. So one is pushing against you and one is pushing you. So the S&P 500 is a general good indicator of the overall stock market. So here we're at the Yahoo Finance website. We're looking at the S&P 500. Under this tab of holdings, we see these sector weightings. And you can get a quick glance at which sectors have the most weighting. Technology sector is a little less than 24%, followed by healthcare, a little over 15%. After that, we got the financial services, which is now at 13%. And then consumer cyclical at 11.39%. And then from there, we go down to about 8.27% with industrials. So I have a group of ETFs here that are correlated with each of those sectors. XLK is a technology sector. In fact, you can look right here when I click on that. Technology, XLV, healthcare, XLF, financials, XLY, consumer discretionary, and XLI Industrial. These sectors make up a good amount of the S&P 500. So when we analyze these individual sectors, we have an idea of what the S&P 500 is going to do. This is a very technical way to look at it. There's other things to look at. Like right now we just started earnings season. The banks have recently reported, causing some of this uptick here. There's also things on the macroeconomic side, like what the Federal Reserve may or may not do with interest rates. If some sort of programs like quantitative easing or Operation Twist or something like that is going to happen. If it's just going to happen and the market knows about it, just the rumors of it can cause reactions. And then you have things like the plunge protection team, which a lot of people think that sounds bonkers, right? But no, it's not bonkers. In fact, in 1988, President Reagan made an executive order formatting this president's working group on the financial markets. So this has been around for a long time, and they basically, at order of the president, can go in and do stuff in the financial markets to get a desired outcome. So all those things come into play. It's not just, what's going on here, but what goes on here is ultimately price action. The price action can be influenced by those things, and we can get an idea of what might come, like generally a little forecast of what might come by looking at some of this information. So right now we're looking at this red line being a 200-day moving average, this greenish or bluish line being a 50-day moving average, and this lavender line being a 20-day moving average. Down here, these red and green things are volume bars, and each of these red and green things represent 1 week of trading. 1 week. And we're looking at a 2-year time frame from here to here. So we see with the S&P 500 that for almost a month it's been close to this 200-day moving average. In fact, it even dipped last week, dipped below the 200-day moving average and closed a little bit below it. Well, this week it opened up above that 200-day moving average and rallied up. Now, this will be a good indication here. Two things that we want to look at. The first one is how quickly can prices get back up to this big drop. So I like to look to the left and look for the closest bearish or bullish, in this context, the closest bearish candle. Now, if we were looking to see if it's going to drop, we'd be looking at the closest bullish candle. But right now we're looking to see how far it might go, how powerful this move is going to be, and so how quickly does it take for prices to rebuild to this spot up here. And then the next thing we'd be looking at is how quickly is it getting to touch this 20-day moving average. And then if it's able to not just touch it but break through, how quickly is it able to rebuild up here. So just for getting back up here, we're looking at here's where it kind of finished its downward projection. So you can count that, not count it, however you want to do it. It makes it a little bit subjective, and ultimately, reading charts is a bit like an art form. And your broker is probably, if you're making money or losing money, your broker is not going to scold you over, did you count that candle or didn't you? So my point here is that if you're making money, who gives a flip, right? So let's count this candle for now. So we got 1, 2, 3, 4. Now we're 4 weeks, 3 to 4 weeks into this, and we're about halfway into this candle right here. Let's look at the rest of these sectors to get an idea of what we might see going forward into the next couple weeks. Technology sector, all right, looks pretty similar, although it wasn't lingering. S&P 500 was lingering for more weeks around the 200-day moving average. This touched it one week, opened above it, closed above it, traded below it, but still closed above it, and then bounced up here. And now we're kind of making that back here. It's kind of like, see this, not just this line, but you see how prices stop right at that line, or pretty close to that line. Prices, they go up to this line, but they draw back, even though it dips down a little bit below this line. And you see over here, look at that, all prices kind of come down to that line, come open up, close down, but bounce back up, touches it, bounce back up. So you see that's like there's sort of an invisible line here in the price action, where if the price is below it, it acts as a ceiling. If the price is above it, it's kind of acting as a floor. And that's resistance or support, depending on which side it's on. So right now we're bumping up against that resistance. Volume is weak compared to what we've seen over the last couple weeks. Healthcare, volume weak compared to what we've seen over the last couple weeks. Now with healthcare, we never even got down to the 50-day moving average. This is about the closest we got to it. It's right in there. And if you look to the left, you see that kind of more in a range here, right? There's this range of prices being down here. It's kind of this range right in there being on whatever side. And right now that's been supporting it. So this week we got up and touched the 20-day moving average, but it pulled back a little bit. And we've kind of had these weak candles moving up. This is kind of a big one, but look at how, like on this candle right here, look at it traded all the way up there, but sellers drove it back down here. This kind of 50-50 on each side with almost opening and closing in the same spot. This one opened and closed a little bit wider, but it's a this wide trading range. So it's moving up, but doesn't look strong, right? Like this looks strong to the upside. Strong movement up, resting, kind of digesting, and another strong move up. Even this, right? Strong, strong, strong. So this, it's moving up, but I don't know. It's not moving up with a lot of power. The financial sector. Financials were lingering around that 200-day moving average longer. That big spindly thing. And same thing here. So in volume for the financials, we're about on par, a little bit lower than what we've seen in these major selling weeks, but you know, on par in this area above that 25, touching that 20-day moving average and kind of moving down, and still below this candle right here, but we are in the upper top 10% of the body of that. XLY, consumer discretionary, still below the 200-day moving average, and you see it was like battling it way back here, fell below. So now volume was weak, and we see we had more trading to the upside than but selling pressure brought it back down here. And as far as if you're hoping for bullishness, what's nice is the body of this candle closed above this one, but we're kind of right in par, right in here. XLI Industrials. This looks, that's a strong candle. That's a wide range bullish candle. Now we closed above, a little bit above that. Maybe we're going to get caught a little bit in some price stagnation area right in there. Volume's looking pretty good. So looking at a line chart over 5 years, I drew this top of the channel, bottom of the channel. Just disregard this. It just what the price I had to pay for getting these lines here. Now we're moving up towards the top of this channel. I think earnings season might see us touching the top of this channel, and we want to see that. I want to see that, and the reason why I want to see that is that I want to see if it's going to break through and stay above that channel, or if it's going to do like it did here, break through and fail. Do like it did here, break through and fail. Do like it did right there, not break through, but test it and fail. And when it does that, you see it falls hard to the downside. So this would be a good test to see if this bear market is going to be over. And by looking at this weekly chart, which there was a link in the description. There was a link in the beginning of this video to a playlist of daily chart videos. You can see on the daily chart it's looking pretty strong, but on a day-to-day basis. But on this weekly chart here, technology's looking strong. Now volume is kind of some people consider it like a secondary indicator. Some people give it more importance than that. Sometimes prices move on low volume, but sooner or later volume comes into importance, and we just want to take note that it's under 80. It's a little lower. It's not down here, but the average volume it's been getting over here. One thing that's good about this also is that prices are basically all the way to the upside. It looks like it almost has a little bit of a wick. You can see a longer one right there. You can see a real long one right there. But when prices are pushing one way to the other, it shows power in that direction. So, you know, it's a tiny little wick right there. Even though this is bullish, it's moving up. this seems like a weak rally. Doesn't strike me as being something really powerful that we can count on. Same thing with this right now. This is still below the 200-day moving average. Now that's so out of these 5 different sectors, this one looks fairly bullish, but it's still coming off that 200-day moving average. It's got to get across there. So overall, I'm guessing right now that even though we could be done with the bear market, until it's really shown that it's out, I'm thinking we're not done. And what a great opportunity for you to learn how to trade in a bear market. And if you don't really know what you're doing, you should paper trade. Paper trade in a bear market. Simulate the trading experience so you can learn how to do it. And if you need a little help with that, go to ihavesuccess.com, download this free stuff. You'll get the daily chart reviews sent to you. You'll also get the weekly one, and you'll get anything else. Like yesterday, I just shared this website that I use to help analyze stocks. There's a paid version of it. There's a free version of it. I don't get any money if you pay for it, but I just use the free version of myself sometimes. So I sent it out to people that have downloaded anything. So consider doing that. And you guys have a fantastic day. And tomorrow, Monday, get ready for another daily chart review. Aloha. Bye-bye.